Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hi, I'm Ravi Singh, Chief Investment Strategist at Standard Chartered Bank India. Welcome to another edition of Views from the Street, bringing you market views and insights on how you should look at your investments from industry veterans and experts. Today, we are joined by Mr. Chirag Setalvad, Head of Equities at HDFC Mutual Fund. Thank you, Chirag, for joining our podcast.
Thanks, Ravi. Thank you for inviting us here today.
So let's get to the most pressing questions on investors' mind. The first question is on India's macro. 2023 has been quite eventful so far, especially on the global front. How do you see India's macroeconomic position going ahead, especially in a relative context?
So, Ravi, actually, India's macroeconomics really stand out from a global perspective. India is going to be the fastest growing large economy, and expectations are that India will grow anywhere from 6 to 6.5%. And keep in mind, this is an environment in which Europe is just about managing to grow by 0.5% to 1%, where America is expected to grow 1 to 2%. And really China, which was expected to grow at 5%, is probably going to miss that target. So India's growth at 6.5% is head and shoulders above other global economies. And that's an impressive number, both from an absolute standpoint as well as from a relative standpoint. So on one hand, you have strong growth. On the other hand, inflation has been a significant concern globally, both in the US, in Europe, and in other markets as well. Whereas in India, inflation at 5.5% is not something which comes as a big surprise. And in a sense, Indian inflation is broadly in line with historical averages, versus globally inflation is far above. And that's why we've seen interest rates rise, and those issues have taken place globally. So both from a growth and inflation standpoint, India stands out. And from a third standpoint, from a political standpoint, you have elections, of course, coming up next year, but we expect there to be continuity. And in that sense, we have a strong political government at the center at the moment, and an expectation that that will continue. So India's politics also stands up well. So all three legs, from a growth perspective, from an inflation perspective, as well as from a political perspective, India actually stands out well. When you look at some of the other factors, I think, which are worth highlighting today, one is, of course, India's banks are in a far better situation today than they've been in the past. I think that's important to keep in mind, because really banks provide the underlying liquidity to the economy. And today we're in a situation where NPAs which had peaked in 2017-18, those have come down significantly. So the position from a non-performing asset perspective is far better. Asset quality has improved significantly. At the same time, we are seeing credit growth, which used to be at 8-9%, has now improved to 12-13%. So not only is asset quality benign, but we are also seeing a sharp improvement in growth in terms of credit offtake. And lastly, capital adequacy today stands at a multi-decade high. So from all three standpoints, banks are in a very strong position. And as I said, banks provide the liquidity, and hence it's extremely important to have a strong financial system. And that is the situation that India is in today. So I think this is another extremely important point to focus on. The fourth point is really when we've spoken a lot about this China plus one. And so far, China plus one has really been a story, and not much beyond that. But now we are actually seeing significant traction on the ground. And China plus one started in the US with Trump putting in tariff barriers. And then, of course, subsequently that has gained momentum through sort of other means. And now we are seeing the diversification of supply chain, obviously because of COVID, concerns of concentration of supply chain in China were enhanced. We've also seen sort of more political issues with China in the last couple of years. So the diversification of supply chain has become an extremely important topic globally amongst multinational corporations. And we are now seeing that moving from conversation to investment and actual offtake. So that's another big change which we're seeing take place. And that's a change which can last for many, many years, and hence it's a strong tailwind to have. And the last tailwind that we've been observing for the last sort of couple of years, or at least for the last year or so, has been a big shift in demand from the unorganized sector to the organized sector. And again, this is an important trend because the unorganized sector in India is very large. Depending on which segment you look at, it's anywhere from 30 to 70% of a particular industry. So having this shift from the unorganized to the organized is also providing a strong impetus to growth. So when you put all of this together from a macro standpoint, having strong growth, benign inflation, and a strong political environment, and on top of that, having a strong financial system and factors like China plus one and the organized to unorganized to organized movement, and really speaks well for the macro outlook from an India perspective. So we are extremely positive on the India story.
Interesting. Now, coming to markets, my second question to you is, Indian equities have been trading in a range for over 19 months now. How do you see markets going ahead? And what could be those drivers for the next leg of performance?
So great question. Markets had rallied, if we go back to 3 years ago, markets had rallied significantly and had reached a point where valuations were clearly stretched. And in the last couple of years, we've seen issues with inflation, interest rates, and certainly the Indian market has seen a significant time correction. I think almost 600 days and the market is flat. And what has happened as a result of the market remaining the same for the last year and a half, we've seen a meaningful correction in valuations. Keep in mind that typically earnings growth is 15-16% per annum. So if a market remains flat for a period of almost a year and a half, that's roughly a 20-22% correction in valuations, just simply because of the passage of time. And that's what we've seen. So the Nifty, as an example, which was trading at a 20-25% premium to its historical average, now has come down to trading in line with its historical average PE valuations. And the same goes for small caps as well. So I think this time correction has certainly been, welcome in the sense that now things are much more sensibly priced. It is easier to find individual opportunities to invest in. And both in large cap as well as in small cap, and that's almost sort of 80-85% of the market, valuations are in line with long-term PE multiples. So the Nifty trades at 17-18 times, and the 10-year average is 17.5 times. Small caps trade at about 15 times, and the long-term average is more or less there. Mid caps trade at a slight premium, but not very far from the historical averages. So across the spectrum, large, mid, and small valuations are now quite sensible. So that's the first part. That's India's valuations. The second is to look at India's valuations versus the rest of the world. And when you look at India's P multiple compared to emerging markets, and if you go back maybe 9 months back, what we had seen is that India had actually outperformed global markets and emerging markets quite significantly. And as a result, Indian markets P valuation premium to emerging markets had jumped to 90%, 90, compared to an average premium of about 45%. And in the last 9 months or so, we've seen India has remained flat, come down a little bit, and globally markets have rallied selectively. And hence, that premium has now come back to 45, which is in line with its historical average. So valuations, whether you look at it on an absolute basis, on a PE basis, that is, we have come back to normalized levels. Even on a relative basis, relative to global markets, we have come back to normalized levels. So what we're suggesting is that are markets cheap? No, but at the same time, markets are not expensive. They're somewhere in the middle. Markets are reasonably priced, and when markets are reasonably priced, your returns tend to be in line with earnings growth, which is not a bad place to be, considering that the domestic Indian economy will grow in real terms at 6-7%. You add another 5% in terms of inflation, and India is growing at sort of 11, 12, 13%. And one should expect that corporate earnings should reflect that growth. And hence, I think the markets will sort of give returns in line with earnings growth. We don't expect a meaningful de-rating or re-rating, but valuations are certainly more sensible today.
Sure. I have a related question on equities, Chirag, more on the broader markets. Mid and small cap equities have outperformed large cap peers over the recent months. Do you see this trend sustain?
Ravi, I think it's a great question, but I think what's important to keep in mind, I'm going to give a slightly different answer to this one. At different points in the market, different sub-segments will perform differently, right? So the last 6 months, small cap, mid caps may have outperformed the prior 6 months or a year. It would have been dominated by another market cap and so on and so forth. So what we have observed over the last sort of 10, 15 years is there are certainly going to be periods of time when large caps do well and other periods of time when mid caps do well, right? And this is the typical market rotation that we see. And interestingly, markets don't only rotate by market cap, they also rotate on various other parameters. So to give you an example, markets will also rotate by style. So sometimes growth will do well, sometimes value will do well, right? Markets also rotate by sectors. So sometimes you'll have IT and pharma and so on and so forth do well, and other times you'll have banks and other sectors performing well. So the important thing to keep in mind is the market will rotate from sector to sector, from style to style, and from different market capitalizations. So it's important to have a presence in all. It is very difficult to figure out what is going to be how long will the current trend last and when will the next trend take over. So it's important to have a presence across. And this is why we tell investors the importance of diversification, to not put all apples in one basket, but to diversify across segments. So I think it's important to be present in large cap, mid cap, small cap, in all three segments. One shouldn't try and pick and choose and skew the portfolio entirely in one direction and have all large cap or all small cap or what have you. So I think depending on an investor's risk appetite and longevity and liquidity and so on, certainly large, mid and small should all be represented in the portfolio. Now, I know I've avoided your question a little bit, so let me answer it a little bit more directly as I see it today. Now, I pointed out earlier that large cap and small cap valuations are close to historical averages, and mid caps are at a little bit of a premium. So putting that into context, hence we are a little bit more positive on large and small, and relatively a little bit less positive on mid caps. Doesn't mean that we're not positive on mid caps, but certainly from a near-term standpoint, the large and small segments look a little bit more interesting.
So now that brings me to a slightly different question. This is more on the institutional flow into equity. We've seen a strong reversal in foreign investor flows since the month of March. And this has been a sore point for fiscal calendar year 2022, where we've seen very significant outflows. Do you see the recent inflows or revival in flows sustain?
So a couple of ways to think about this. One is the importance of FIIs to markets, and the other is the importance of FIIs to the domestic economy. So let me take the second part first. I think it's important to keep in mind that India's invisibles, which is the export of services and software and so on, that has jumped significantly. So this used to run at a pace of about $5 to $6 billion per month. And in the last 2 years, this has increased to about $11 billion a month, which means roughly 4 to 5 billion additional inflows on a monthly basis, because India's export of software, India's export of BPO services, managed services, and so on and so forth have increased. And that means that you're getting $40 to $50 billion additional flow coming in from a steady source. And hence the reliance on FI money from a global balance of payment perspective has come down. So in a sense, the reliance on FIs from a rupee standpoint and from a balance of payment standpoint is less. From a equity market standpoint, I think the reliance is there. It is meaningful. FIs do own a meaningful portion of market cap, and they do certainly move markets and accentuate the trends that are visible in markets at any given point. But I think the domestic part of the market, and this has been obviously highlighted by many participants, is that domestic institutions are playing a much more important role, right? Whether that is domestic insurance companies or mutual funds, we all know the SIP story and how that has ballooned and sustained over a period of time. And hence the reliance on FIIs has somewhat come down. And the importance of steady, secular investors like insurance and mutual fund players has increased, which I think is a big positive, certainly. But let me also lastly end it by saying that India is a large economy. We will be one of the top five economies of the world at the moment, and India is a large equity market. India's story really stands out. There is no other economy that you can think of which is growing reasonably well. Valuations are reasonable, ROEs are steady, where you have 3,000 listed companies, large companies to invest in, where corporate governance standards are improving over a period of time and so on. And hence, while India can be ignored for a period of time, I think over a longer period of time, the interest of FIs will only increase. Right? We are not a commodity market which is very cyclical in nature. We have a lot of secular elements in our economy. So I think the India story, while There'll be FI interests which will wax and wane depending on risk appetite, depending on the performance of other markets, depending on the performance of large developed markets. But over a period of time, India is becoming a much more central part of global investor portfolios. So if you go back 20 years ago, India would have been fringe. Now India is certainly becoming much more mainstream. And I think in that sense, it's a big positive. So foreign inflows will be volatile in the short term, certainly, and impossible to predict. But over an extended time frame, you will continue to see meaningful FI inflows coming into India.
Sure. Now that brings me to my last question, and this is more on what are the emerging trends and areas of opportunities within Indian equities that you see?
I think the key in equities is to have a solid basic approach. And that means that one should have an extremely long-term horizon. You should be investing for a minimum of 5 years and typically for as long as you can. I think it's important to have a steady approach to investing, which is to focus on SIPs, to enhance that SIP investment with periodic lump sum investments, ideally put in when the market is going through a tough time, and to be a little bit contrary as a result. So I think patience and a long-term perspective is really what is the key when investing in markets. Having said that, though, we are seeing a few trends which are emerging. We are seeing a greater emphasis today by investors, certainly in terms of passive flows. And yes, I do think over a period of time that passives will have an important role to play. But I think what we forget is that alpha tends to be seasonal. And what that means is that for active funds, and active funds are driven, investments in active funds are driven by alpha, it's not that alpha comes down overnight. There are periods of time when alpha is higher and other periods of time when alpha comes down. And that is driven a lot by the concentration of market movement. So when you have a few stocks which drive performance of the overall market, then alpha becomes harder to find. And when you find that the performance is more broad-based, then alpha is a little bit easier to find. So last 2-3 years, alpha has been difficult to find. The 2-3 years before that has been a little bit easier. And the 2-3 years before that, again, it was more challenging. So I would put that in perspective. I think thinking that this is all about passives now going forward, I don't think it's going to be as easy as that. But that is certainly one emerging trend which seems to be taking place today. But I think the key in all of this is not to look at emerging trends, but to focus on the basics, right? In trying to get fancy and trying to look at the trends of today, we forget the ABCs of investing, which is to invest for the long term, to invest in a contrarian fashion, to be steady, and to make sure that asset allocation is at the right point.
Thanks a lot, Chirag. The entire session was very insightful, and it's always been a pleasure talking to you.
Thank you, Ravi. Thanks for having us on this podcast.
This brings us to the end of this edition. Thank you as always for listening. If you enjoyed this podcast, please like and subscribe.
Disclaimer from HDFC Mutual Fund. The views explain general market trends in the securities markets and are based on information already available in publicly accessible media. Stocks, sectors referred are illustrative and should not be construed as an investment advice or a research report or a recommendation by HDFC Mutual Fund or HDFC Asset Management Company Limited to buy or sell the stock or any other security covered under the restrictive sectors. The fund may or may not have any present or future position in these sectors. Past performance may or may not be sustained in future. HDFC AMC is not indicating or guaranteeing returns on any investments. Readers should seek professional advice before taking any investment-related decisions. Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.